Okay, welcome everybody to the New York Alternative Investments Roundtable January Forum, Economic Outlook, Recovery in the Midst of Disruption. I'm Alessandra Tocco, the president of the Roundtable, and we're glad you're able to join us this afternoon. Before we get started, I'd like to take a moment to thank the Roundtable sponsors who you can see on the screen. We are thankful for continued support of such a wonderful group of actively involved industry professionals. Now for a few logistical items. Today's event is being run as a webinar. While this means you can't see the other attendees, it is the most secure way for holding online events. But we encourage you to still ask questions, and we'll be looking at both the chat function and the Q&A functions continuously through the seminar. Today, we are very excited to have Dr. Ira Kalish, who is going to share with us some of his thoughts on the economic outlook and the risks that investors should be aware of, from inflation to supply chain and labor markets. Ira is the chief global economist for Deloitte, where he specializes in global economic issues, as well as the effect of economic, demographic, and social trends on the global business environment. He has written about countries of Western and Eastern Europe, Southeast Asia, China, Japan, Mexico, South America, and has also written extensively on global consumer markets. He is the principal author and editor of Deloitte's weekly Global Economic Update, among other publications, and advises both the firm's clients and readership on economic issues and their impact on business strategy. Ira also serves on the OECD Economic Policy Committee, which advises the OECD on macroeconomic policy issues, as well as the World Economic Forum Community of Chief Economists. We are very fortunate to have Ira today, and without further ado, I'd like to turn things over to him. Thank you, Ira.
Okay, thank you, Ali, and good day, everybody. So what I'd like to do is tell you what I think is happening in the economy and where it's going, what are some of the challenges and risks and opportunities with the economy right now. Over the past 2 years, during the pandemic, every time I've spoken to anybody about the economy, I've usually begun with a discussion of the pandemic, because at the end of the day, what we've learned is that when there are outbreaks of the virus, it has an impact on the economy. Even in the absence of lockdowns or economic restrictions, outbreaks tend to lead at least some consumers to avoid social interaction in ways that affect the amount of money they spend, and that has an impact on overall activity. Plus, in some parts of the world, outbreaks have been met with reductions in employment, reductions in production, and disruption of supply chains, which have an impact on the level of activity as well as on inflation. So let's begin then by discussing the pandemic. And if I could have the next slide, please. There we go. So what you see here is the share of the population that's fully vaccinated against the virus in multiple countries. And this is very important, because what we've also learned is that obviously we can have outbreaks of the unvaccinated, but the cost of that is not very high. So for example, right now, during the past month or so, we've been in the midst of the very severe Omicron outbreak, and we've seen a huge surge in the number of people infected, both here in North America as well as in Western Europe. But what's been interesting is that we've seen much higher rates of infection in several European countries than in the US, and yet much higher rates of hospitalization here in the US than in Europe. So the human impact of the outbreak has been much greater in the US, mainly because we have a much lower rate of vaccination. And that in turn has economic implications. So you can see that the US actually got off to a very good start in terms of vaccinating people, but around June, the slope of that line dropped sharply, and as of now, the share of Americans that are vaccinated is considerably lower than in Canada and Western Europe, in China and Japan, and even lower than in Brazil, and only slightly higher than in Russia and India. So that's a problem for the US going forward. A lot of people suggest that the Omicron variant might be the last hurrah of the pandemic. Let's hope so. And that future variants will be less impactful, and that we'll basically learn to live with them the way we learned to live with the flu, which is sort of directly descended from the great influenza of 100 years ago. But we don't know for sure, and there could be more onerous and ominous outbreaks going forward. So what we've seen during January is a sharp slowdown in the U.S. economy as a consequence of the Omicron outbreak, and that will probably have negative implications for first quarter economic growth. If you assume that this is the final hurrah and that we're not going to be severely affected by COVID in the months to come, then the U.S. economy should do quite well going forward. But of course, this remains one of the major risk factors for the economy. Next slide, please. But enough about the virus. Let's talk about the economy. And we've had a pretty good run. It appears that in 2021, the U.S. economy grew around 5.5%, which is pretty strong. It's likely to grow at a good pace this year, other than in the first quarter. We have a lot of good things going for us. Americans have a lot of money in the bank. We still have a relatively easy monetary policy, which is starting to change. We had massive fiscal stimulus last year, and we're still enjoying the after effects of that, although that's starting to abate. So the economy is in pretty good shape. And yet, as the US and global economies grow, we're seeing some significant disruptions from supply chain, much higher inflation, shortages of labor, and these are all related. Now, the inflation we're experiencing, which I'll talk a lot about, is partly due to a surge in consumer demand for goods, combined with limited ability of companies to meet that demand, in part because of disruption from the pandemic. So let's look first at consumer demand, particularly here in the US. On the left-hand side, you can see that early in the pandemic, there was a sharp drop in consumer spending on both goods and services. They both bounced back quickly, but there was also a very significant shift in the way that consumers spend their money. Because people were stuck at home, or because people were averse to social interaction, they cut back on spending on services like restaurants, movie theaters, airplanes, hotels. And even today, spending on services is below the pre-pandemic level, as you can see. On the other hand, because people were spending less on that, they spent more on goods, especially for the home. They bought big screen TVs and other electronics, furniture, appliances, treadmills that they didn't necessarily use. And so you can see that there was a huge increase in spending on goods. And at one point, it was about 20% higher than the pre-pandemic level. You can also see on the right-hand side, retail sales have kind of peaked, which is a good thing, actually, because this is mostly spending on goods, which increased so dramatically and was so disruptive to the global economy. And yet, over the past several months, retail sales in the US have largely stabilized. And this is nominal retail sales. So if you subtract inflation, that means that real retail sales have been declining. So that suggests that some of the disruption to supply chains that we have seen is starting to abate, and that's good news when it comes to inflation. Next slide, please. So there are two sides to the supply chain problem. One is the demand side, and we've seen that, a huge surge in especially US demand, but also global demand for goods, much of which come from Asia. And then on the supply side, there have been difficulties in meeting that demand. There have been shortages of commodities and inputs. There have been restrictions on operation of factories and ports, especially because of the zero tolerance policy in China, whereby if one person in a port or a factory gets infected, they shut the whole thing down. And that has had a cascading effect on global supply chains. We've also had what we call the bullwhip effect, whereby individual companies worried about shortages stockpile inputs or commodities that they need. They boost their inventories, and that makes sense for them individually. But if every company does that, that exacerbates the problem of shortages and leads to more inflation. So you can see what's happened in terms of supply chain shock. On the left-hand side is the Baltic Dry Index, which is a measure of the cost of shipping commodities. That increased dramatically over the past year, but has in recent months fallen sharply, suggesting that some of that supply chain shock is dissipating. On the right-hand side is the Harper's Index, which is a measure of the cost of shipping containers. That increased very sharply. It hasn't fallen, but it does seem to have peaked. So the good news is that it appears that we may be now starting to turn the corner and that a lot of the supply chain disruption is starting to abate. And if that happens consistently over the coming year in line with a decline in consumer spending on goods, then that should help to reduce the inflationary pressures that we've seen. Next slide, please. So let's talk about inflation. We have seen a huge increase in inflation here in the US and elsewhere. In December, consumer prices were up 7% year over year, the highest in over 30 years. And that has set off a debate as to whether we're seeing a temporary surge in inflation or are we at the start of a new era of 1970 style persistent inflation. And it depends on what you think is causing the inflation. If you think it's because of massive fiscal and monetary stimulus, which we have had, then that could lead to sustained higher inflation and a kind of wage price spiral. If instead you think that the inflation is largely due to what's happened with supply chains, then it may be temporary, and that once that supply chain disruption goes away, then the inflation should probably go away. Now, if you look at this chart, this suggests that maybe it is a supply chain issue, because this shows the blue line is inflation in the price of goods. The red line is inflation in the prices of services. They have diverged dramatically. We've seen a huge increase in goods inflation, but almost no movement in services inflation. And that's very unusual, and it's certainly different than what we saw back in the 70s when the prices of both goods and services increased dramatically. This suggests that it has to do with supply chains and how they affect the prices of the goods that move through supply chains. And again, if supply chain disruption abates, then that goods inflation will abate, and then we'll be back down to a normal level of inflation. That's my view, and that is the view of the Federal Reserve and other central banks, that the inflation we're experiencing is not over. It may get worse before it gets better, but over the course of this year and next year, it will abate, so that probably by the late 2023, we'll be back down to a normal level of inflation of maybe 2 to 2.5%. Next slide, please. And by the way, another piece of evidence that it's not the massive US fiscal stimulus that generated inflation is the fact that inflation has risen everywhere, including in countries that didn't have that big fiscal stimulus. What you see here is inflation in the US and Germany, the UK and Canada. They're all up at different speeds and at different rates, but they're all moving in the same direction. And again, my expectation is that over the next year and a half, they'll also move in the same direction of substantially abating. Next slide, please. Now, I speak to a lot of our clients about this, and I tell them my view, but what I'm hearing from a lot of our clients is that they're really worried that maybe this thing isn't going to go away. Maybe it will have a life of its own and it will be sustained. And in fact, you could make an argument that if people in the economy change their expectations of inflation in the face of higher inflation now, that will change their behavior in ways that exacerbate inflation. So, for example, if workers expect persistent inflation, they will demand higher wages, and businesses will offer that, and that will set off a wage price spiral. If the virus hits us again and we have further disruption of supply chains, that can extend inflation. So there are things that could lead to sustained higher inflation. And this is what many business leaders are worried about. And yet, if you look at what's going on in the bond market, it's evident that investors themselves are not worried about inflation. And you can see that in the chart you see here. This is the so-called break-even rate, which is a very good and accurate measure of bond investor expectations of inflation. Let me explain quickly how this is calculated. The Treasury issues a regular 10-year Treasury bond, which has a particular yield, but they also issue an inflation-protected bond, where the principal value moves in line with inflation so that the yield on that bond is the after-inflation yield, the real yield. And the difference between the two yields is expectations of inflation. That's the break-even rate. And you can see it here for both the 10-year bond and the 5-year bond. Now, clearly, inflation expectations rose during the pandemic, peaking middle of last year, and then stabilizing for a while at about 2.5%. Now, in recent months, we've seen a bit of volatility when oil prices suddenly surged. The break-even rate went up, then it came down, then it went up again. But basically, right now, where it is at a level that's not especially onerous. The 10-year rate is still at about 2.5%, maybe a little bit above that. That means bond investors think over the next 10 years, inflation will average 2.5%. So they've evidently bought into the argument that the Federal Reserve has made that this inflation is in fact temporary. They're no longer using the word transitory, but I'm not sure what the difference is. But in any event, that's the view of the Fed, and that's evidently the view of bond investors. The other interesting thing about this chart is that the 5-year break-even is now higher than the 10-year, which is unusual. It's usually the other way around. And that suggests bond investors think there'll be a surge in short-term inflation, but in the longer term, inflation will come down. Again, consistent with the Federal Reserve's view. Now, the Fed could be wrong in their expectations of inflation. I could be wrong, although that's never happened before. But in any event, if we're wrong, then that will show up in the numbers on this chart and in many other numbers. And in that case, the Fed will likely tighten monetary policy faster than they're now doing, even at the cost of stifling economic recovery. Now, I should mention the Fed has, in fact, started to tighten monetary policy faster than they had previously expected. That reflects the fact that they're cognizant of the inflation that's out there. They want to anchor expectations of inflation. And they're also no longer focused, as they were before, on economic growth and employment. It's clear now that we're at full employment, that there's a tight labor market, that the economy is growing at a good pace. There's no longer any need for monetary accommodation. And that's why the Fed is starting to predict that they're going to raise short-term interest rates in the months ahead. They're starting to taper asset purchases and will, in a few months, stop buying bonds and maybe even sell bonds. And that may be why we've seen a sharp rise in the last month in bond yields, even though there hasn't been a sharp rise in inflation expectations. It has to do with the fact that investors recognize that the Fed is going to stop buying bonds and that the economy will grow quickly. On the other hand, bond yields are still historically low. That reflects the fact that in the long term, investors expect low inflation, and they also recognize that the Federal Reserve, that the US government is going to be borrowing far less this year than they did last year. We're having much less fiscal stimulus. Next slide, please. So let's talk about the state of the overall economy. On the left, you can see real GDP, which dropped really sharply early in the pandemic and bounced back quickly. It was actually the fastest or shortest recession in US history. And you can see that right now, real GDP is above the pre-pandemic level. Among the major economies in the world, this can only be said about the US and China. It's not true of many other countries. And yet, what's also clear is that if you draw a straight line through that pre-pandemic path of real GDP, we're below that path. That is to say, we're below the point where GDP would be if there had been no pandemic. Why is that? The major reason, in my view, is that there's been a decline in labor force participation, which you can see on the right-hand side here. Labor force participation declined for a number of reasons. You can see that there's been an especially sharp decline for older workers, many of whom during the pandemic chose to retire early. They saw their 401ks go up in value. They were home. They weren't spending money. They saved a lot of money. They saw their houses go up in value. So they probably figured, we've got enough money, we can retire. And they did. But other people have dropped out of the labor force as well. A lot of working age parents dropped out because it was difficult to take care of children who were not in school full time and work at the same time. We saw actually pretty substantial drop in participation by college educated women. We also saw people drop out because of fear of the virus. We saw people drop out because there was a skills mismatch. Maybe they lost jobs in retail, but they don't have the skills needed for some of the jobs that are being created. And then we also saw the labor force decline in size because of a very sharp drop in immigration in the past 2 years. So all of these things conspired to create a shortage of labor. Next slide, please. And you can see the nature of the shortage of labor. On the left-hand side is a measure of job vacancies, both in the US and elsewhere. This is a global phenomenon. And vacancies are jobs that are available, but where businesses have been unable to fill those vacancies. And that has increased really sharply here in the US to the highest level we've ever seen. On the right-hand side, you can see the quits rate. This is the share of jobs that people voluntarily quit each month. It's also at the highest it's ever been. And this may reflect the fact that some people are dropping out of the labor force, or it reflects the fact that many people feel like jobs are available. I can quit this job that I don't like, and I can easily find another one. So we're seeing a lot of disruption in the job market, and clearly, based on conversations I've had with clients, a very severe shortage. And yet you would expect with such a shortage, there would be a tremendous surge in wages. And indeed, wages have risen, but not nearly as much as you would expect. Next slide, please. So here's what's happened for a variety of industries. Wages have accelerated. As you can see, in many industries, wages have been rising in the past year at a rate of 4 or 5, maybe 6%. But keep in mind that right now inflation is at 7%, which means that for most of these industries, wages have risen less than prices, which means in real or inflation adjusted terms, wages have actually declined. So we're not getting an inflationary impulse from this labor shortage. You might have expected otherwise. You might have expected a dramatic surge in wages that would fuel price increases and set off a wage price spiral. That's the kind of thing that would lead to sustained higher inflation. So far, it hasn't happened yet. The only industry here where we've seen that dramatic surge in wages is leisure and hospitality, which is restaurants, movie theaters, hotels. Those are very labor-intensive industries. If you don't have the labor, you can't provide the service. So companies in those industries have been willing to offer very big pay increases in order to get the number of people they need, and they still don't have the number of people they need. In other industries, we've seen wage increases, but we've also seen other things take place, like signing bonuses, retention bonuses, so that companies are not stuck with higher weekly or monthly wages. We've also seen many companies increase their investments in labor saving or labor augmenting technologies in order to boost the productivity of existing workers rather than pay more for those workers, or in order to justify the extra cost of those workers. In any event, that's the nature of the labor market right now. So far, it's not inflationary, but we'll have to keep an eye on that. Next slide, please. Finally, let me say a word about what a post-COVID world might look like. Now, during the pandemic, we've seen a dramatic change in the behavior of businesses and people, and much more of a remote world. And the question is, will this persist going forward? Well, based on the surveys I've seen and based on just conversations I've had with clients and with colleagues, it appears to me likely that even once the pandemic is truly over, that a much larger share of workers will spend a much larger share of their time working remotely from home, and that a much larger share of retail spending will take place remotely online, and maybe there'll be less business travel. And so, as a consequence of this shift toward a remote world, there are indeed consequences, let's say. So that means less traffic on the road, less use of public transportation, less use of airplanes, and that in turn implies less energy demand and therefore lower oil prices going forward. Now, we've seen a rise in oil prices lately because of a huge surge in demand as the world reopens, and at the same time, there hasn't been adequate investment in new capacity. So we are seeing a big increase in oil prices now. But in the longer term, my expectation is that if we move more toward a remote world of less transportation, that would suggest, all other things being equal, lower oil prices. We've seen during the pandemic much less investment in structures like office buildings and shopping centers, and more investment in information technology to accommodate a remote world. And my expectation is that that will continue. And if it does, that could create financial stress in the sense that there are many securities that are backed by commercial property mortgages, and they could lose value substantially. There could be a shift in productivity. During the pandemic, we've seen an acceleration in labor productivity, possibly because of this investment in information technology, allowing more remote interaction. So that's a good thing, and that might continue. On the other hand, there's evidence that innovation, which drives long-term changes in productivity, often takes place during the informal moments when people share ideas, when they get together in person. And if we never get together in person again, that could have a long-term negative impact on productivity. So perhaps an ideal situation would be where we engage in a lot of remote interaction, but we have many opportunities to get together in person and share ideas. Finally, this remote world has implications for the labor force, which we may already be seeing. It probably means the permanent destruction of certain jobs, like in retail stores and shopping centers, for example, and more jobs in technology and pharmaceuticals and professional services. And if that's the case, we may be stuck with a very severe skills mismatch in the labor force, which creates a suppression of labor force participation and maybe exacerbates the problem of income inequality. And the solution, of course, to that would be long-term more investment in human capital. Next slide, please. So that's the end of my formal presentation, and I'm happy to take questions, and I see there are a few in the chat box, so let me take a look at these here. First question, is it possible that a supply chain causes of inflation abate that will be replaced by labor cost increases, which will cause inflation to persist, perhaps at lower levels? It is possible. I mean, so far we haven't had that happen yet. We have seen an acceleration in labor costs, and some have been greater than others. It's really varied by industry, by income level, by skill level. So, for example, we've seen bigger wage increases for lower paid workers than higher paid workers. We've seen bigger wage increases for young workers than older workers. Interestingly, we've seen bigger wage increases for women than for men. I'm not sure why. So there are some interesting things happening, but so far we haven't seen a broad-based increase in labor costs that could set off more persistent inflation. So it's a possible scenario, but so far it hasn't happened. Next question. How do you think the providers of shipping and storage will evolve due to the current issues? How do you think companies that produce and consume will evolve their approach to the supply chain? Will changes lead to a reduction in long-term inflation due to better delivery of products? Well, I mean, prior to the pandemic, we had pretty efficient supply chains. And if we move back to that level of efficiency, that should help to abate inflation. However, one thing we've seen during the pandemic is companies became more aware of how vulnerable supply chains are. And I think as a consequence, they're going to make some changes. We're already seeing anecdotal evidence of more diversification of supply chains, especially companies shifting some processes out of China to, say, Southeast Asia or India or Mexico, or maybe even back home. I think there's a greater focus, or will be a greater focus, on supply chain redundancy and resilience. So those things could add some costs, but they will protect against substantial disruption the next time some big thing happens. And many governments of developed economies like the US, Japan, European Union are starting to take steps to encourage companies to be less dependent on China and maybe to shift some supply chain processes back home. Let's see, next question. Given the changes in monetary policy you expect, can you speak a bit about real estate and mortgage rates? Yes, that's obviously top of mind for all of us. So my view is, as I said earlier, that I think long-term borrowing costs may go up a bit more, but I don't expect them to rise dramatically unless there's a surge in expectations of inflation, which I don't expect. So I think that mortgage rates, although they've risen and may rise a bit more, I don't think they're going to rise to the point where it has a profound effect on the residential market. Right now, the housing market remains very strong. We just saw this morning the S&P Case-Shiller Index is up, I think, about 18% year over year, and up about 1.5% month to month. I'm not sure if I got that exactly right, but in any event, the housing market's still very strong and very tight, particularly in some parts of the country. And what's happened during the pandemic is not just low borrowing costs, but a change in behavior. A lot of people who found themselves working from home and expect to continue to do that decided, we need a bigger house. We need 2 home offices for husband and wife. We need a gym because we're not going to the gym anymore. So people have been moving further out to the suburbs or even to rural areas, buying bigger homes, and that has set off an increase in house prices, and that may continue for a while. It's hard to say. Once the pandemic is over, there are some people who think everybody's going to move back to the cities, to smaller homes. I don't know. We'll have to wait and see. Do you see employee shortage to create long-term acceleration of technology robotics to replace lower skilled workers? Yes, we're already seeing more investment in labor saving and labor augmenting technology, partly in reaction to the shortage of labor, partly in reaction to the fact that we're becoming a more remote world. A lot of companies say they've done 5 years of digital transformation in just 5 weeks or 5 months. So, yeah, I expect to see more of this. One of the things that has suppressed labor supply growth has been a dramatic decline in immigration, which predates the pandemic, by the way. It really started to slow down in around 2016, and then in the pandemic, it slowed down even more. And unless we start to allow much more immigration, we're going to have a shortage of labor. We've had for a long time very few births. The population is growing very slowly. The working age population is growing especially slowly. That's not just a U.S. phenomenon, that's all over the world. So I think we may see a persistent shortage of labor. We're seeing a lot of retirements of baby boomers, and the successor generation who are coming into labor force is smaller. So yes, more investment in technology and robotics. I don't see any other questions here. Ali, are there any other questions that you're aware of?
I don't see any in the chat. Britt, do you have, here comes one right now. What are the biggest risks you see coming out of the Ukraine?
Oh, there we go. Well, there's a question we can spend about a couple of hours talking about. Well, I mean, this is what's been interesting to me is that this has been in the news for a while. I mean, we knew 2 months ago that the Russians were amassing troops on the Ukraine border, that Biden was having repeated video conference calls with Putin. There's been a lot going on and a lot of tension and a lot of concern. And yet it was only last week that a client first asked me about this, which suggests to me that now finally the business world, the financial community is starting to think about the potential consequences of this, that this is getting real. And we've seen that show up in financial markets in the past week with a drop in share prices, a drop in bond yields. Drop in bond yields is a reflection of a flight to safety. So people are worried about this. There's uncertainty about what the potential implications can be. I think Vladimir Putin has gotten himself into a bind in that he's put all these troops on the border. He's threatened to invade. He's made all sorts of demands of NATO that are non-starters from a NATO perspective. And yet, if he backs down now, it will be sort of a loss of face. So he can't back down. And yet, if he invades, he's going to pay a terrible price in terms of economic and financial sanctions, as well as, for the past 10 years, his goal has been to divide NATO. This is doing nothing but uniting NATO and now leading the US to send more troops into Eastern Europe, which is precisely the opposite of what Putin wants. So I don't think he necessarily wants to invade Ukraine. I think he wants to get some sort of settlement from the West that would assure him that Ukraine will not become a Western-style democracy, which would be a threat to his authoritarian regime. I don't know what the outcome will be. I don't know what the economic ramifications would be of an invasion. I think if there is an invasion, we'll see some financial market volatility right away. We'll probably see a big increase in the share price of aerospace and military equipment producers. But other than that, it's hard to say. I guess the big question is what happens to oil prices. If sanctions have a disruptive effect on Russian oil companies, then maybe oil prices go up. So I'm not sure. Let's see. Next question here. Please share your thoughts on how China's growing influence will pan out in the longer run and potential impact on the U.S. Well, China's influence is certainly growing. It's under the regime of Xi Jinping. They become far more aggressive in places like Hong Kong, the South China Sea, Taiwan, Xinjiang province, more authoritarian, more statist rather than focused on the private sector, and investing massively in very sophisticated military technology. So those are all concerns. On the other hand, it's clear that China faces some significant challenges that are likely to significantly slow their economic growth. For example, right now they have this zero tolerance policy toward the virus, which has inhibited economic growth, and it's not clear for how long they will keep this policy. There's some speculation they might end it after the Olympics. They have a massive disruption of the residential property market, which is huge. And that disruption means that residential property is going to decline. And as a consequence, the economy is going to grow more slowly. The IMF today just announced their revised forecast for GDP growth in China for this year is 4.8%, which is really slow by recent historical standards for China. And that may be too high an estimate. We do know that in the fourth quarter of 2021, real GDP was up year over year 4%, one of the lowest rates in the last 30 years. Part of that was a sharp drop in activity in the property market. And construction and property development account for 29% of GDP in China, compared to, say, 15% in the US. So the drop in the property market is going to significantly slow their economy. They have very onerous demographics. It's possible that next year the overall population will decline. The increase in the population last year was less than 500,000 out of 1.4 billion people. And the working age population is already declining. This is the lagged effect of their one-child policy, which they ended a few years ago, but since then, people are still having just one child. They can't get people to have more children. So all of these things are conspiring to hurt China, on top of which their policy of providing more support to the state sector and less support to the private sector, cracking down on wealth creation, those are things that are likely to have a negative impact on economic growth also. So yes, China's military is growing, but I think they're going to face a lot of issues. Let's see, next question here. With the M&A market at historic levels, rising rates, inflation, or anything cause a concern for a slowdown in deal flow? That's a very good question. I don't think so in the short term. As I said, my expectation is that borrowing costs are going to remain relatively low from a historical perspective, even though they may go up somewhat. And on top of that, companies are flush with cash to a degree we've never seen before. A lot of businesses during the pandemic borrowed either through banks or through the bond market and then just put that money in the bank. They were hoarding cash for a rainy day, as did consumers. So there's plenty of cash on hand. Borrowing costs are low. I'm expecting still relatively strong economic growth, both here and overseas. We're in the midst of a massive digital transformation, which requires a lot of restructuring. All of those things probably bode well from an M&A perspective. So I guess I would be cautiously optimistic about the M&A market for the next year or two. Could you share your perspective on the report of the IMF on global growth, expected to fall from 5.9 to 4.4% this year, which is a half percentage point lower than the October forecast, and down to 3.8% next year? Sure. What the IMF said was that one of the major reasons for the downgrade of growth expectations is because of the impact of the Omicron variant on first quarter growth. Most of the downgrade to their global growth was due to a downgrading of the US and China, which are the two largest economies in the world. In the case of the US, there's considerable evidence now that the economy kind of stalled in January, mainly because of the Omicron variant. Yesterday, we got the purchasing managers' indices for both manufacturing and services. And what they showed was a slight deceleration of manufacturing in January, but a dramatic deceleration of services, whereas in December, the services sector had been growing strongly in December. In January, it just completely stopped growing, mainly because with Omicron and some restrictions in some places, but voluntary restrictions on the part of many consumers, people cut back on going to restaurants, getting on airplanes, that sort of thing. So that had a negative impact on economic activity, which means even if it bounces back in February, it means the first quarter is looking ugly. And first quarter growth will be much slower than we otherwise expected. And if the slowdown is only because of the first quarter, then that slows down the growth for the whole year. And likewise for China. China has had multiple lockdowns of major cities in the last month or two because of Omicron, even though they haven't had really big outbreaks. If you look at a city like Xi'an in central China with a population of 13 million, they had a couple of dozen infections reported, and they shut the whole city down. People couldn't even leave their homes other than to get groceries. And that has an economic impact. And that's part of their zero tolerance policy. So those are the major reasons for the downgrade. The other thing that came out from the IMF is that they also subscribe to the view that inflation will be temporary and will come down. But in their revision, they said it will probably last longer than they previously expected, but it will still come down over the next 2 years. Let's see, other questions. Any prediction on when we might see a positive short-term real interest rate? Not for a while. I mean, right now, the Fed funds rate is 0.25%. Inflation is 7%. My expectation is the Fed funds rate by the end of this year will be maybe 1% or 1.25%. Maybe by the end of the year, inflation will be 4 to 5%. So still a very negative real interest rate. So it may last for a long time. Here's a question that came in through Q&A. What do you see for the oil markets in this year and next year? Well, the rise in oil prices we've seen was due to a surge in demand because of a rebound in the economy and a rebound in transportation activity. But also because during the pandemic, there's been limited investment in new capacity. Plus, OPEC plus Russia have been surprisingly successful at controlling production and suppressing production. However, going forward for the remainder of this year, we're starting to see more investment in capacity, especially on the part of shale producers in the U.S. OPEC plus Russia have agreed to increase production. We're seeing negotiations continue between the West and Iran, which could lead ultimately to the release of sanctions on Iran, which would lead to a dramatic increase in uranium production. So there are a number of things that could either help to stabilize or suppress oil prices in the next year or two. So my view is I'd be surprised to see a much further increase in oil prices. I mean, they could go up more, but I'd be surprised if it's much more. And I wouldn't be surprised if oil prices start to come down. What about climate change? Okay, so I guess what we've seen, I mean, if you had asked me 5 years ago, do I think there'll be a lot of change in business or government behavior in response to climate change, I would have said, no, probably not. Now, I think I've changed my mind. And the reason is we're seeing a lot of things take place. We're seeing major countries, and now including the U.S., make commitments to climate targets. Some countries and some U.S. states have imposed regulations which will require significant changes. Although Biden evidently, I mean, he didn't get his Build Back Better bill, which had a lot of climate legislation in it, and it's not clear if he'll get a bill going forward or some part of a bill going forward, but we'll have to wait and see about that. But what's been interesting to me is that the private sector has acted to a much greater extent than I would have expected. And it's been partly driven by the financial sector. Many banks, insurance companies, asset managers are increasingly allocating resources and portfolios and assessing risk on the basis of climate considerations. And as they do that, that compels non-financial companies to take climate-related action as well. On top of that, there was an interesting story recently about how the 1,500 largest, among the 1,500 largest financial asset managers in the world, managing about $40 trillion in assets, have mostly committed to divesting themselves of assets related to carbon emissions. That means divesting oil and gas companies, for example. And as that happens, that's likely to have some impact, especially on energy companies. We have seen less investment in new capacity in oil and gas than we might have expected, given where prices are, and that may persist to some extent as energy companies themselves shift toward more investment in clean energy. So I think we'll see some things happen. Now, whether or not the things happening will be sufficient to protect us from catastrophic climate change, I don't know. Next question. Another question here. Any view on public companies buying back stocks versus an increase in capital expenditures? That's a good question. I mean, we did see a lot of share buybacks after the tax cut in 2017, and not a lot of increase in capital expenditures. But right now, I mean, there are three major types of capital expenditures that the government follows. There's investment in structures, investment in equipment, and investment in basically intellectual capital. So investment in structures is way down and it's not recovering. Investment in equipment, mainly transportation equipment or information technology, is booming. And investment in intellectual property is booming as well. So I expect those trends to continue. Now, whether or not, I mean, share buybacks are generated often by tax considerations or often by a focus on, generating returns for shareholders when share prices are not doing what you want them to do. They may not be doing what you want them to do right now, so we may see more share backs in this environment. But I expect that we'll have a pretty good environment of capital expenditures other than on structures, which would be office buildings, shopping centers, and so on. do you have any insight on power grids relative to increasing loads, especially due to more production of electric vehicles? If the grids can't handle the demand, what happens? That's a really good question. Sadly, it's outside my area of expertise, so I don't really know the answer to that. I'm just happy that I'm a homeowner with solar panels on my roof, so I'll at least have enough power if the power grid goes out. Let's see. I think that's the last one I see. Are there any others, Allie? You're muted.
If you were head of the Fed, I think there's a question, what would you do next?
That's a good question. I mean, I think Jay Powell has pretty much gotten it right. I think he was correct to wait for a while. I mean, and it's a change from the past. Normally in the past, the Fed would start to tighten monetary policy in anticipation of inflation in order to anchor expectations and avoid a surge in inflation. He didn't do that this time, in part because the sudden surge in inflation was a bit of a surprise to everyone. Plus, he and others view this surge as related to one-off factors that are likely to go away. So for a long time, Powell was more concerned about employment than about inflation. And the Fed does, in fact, have a dual mandate from the Congress to focus on both, to target both inflation and employment. But now that we're at full employment, he's made, I think, the wise choice to start to tighten monetary policy. If nothing else, then as a signal to investors that he's going to focus on this and not let inflation get out of hand. I don't think the tightening of monetary policy itself will actually have much impact on inflation. I think what will have an impact is businesses getting supply chains back on an even keel. So I would, if I were Fed chairman, I would continue with what he's doing. I would probably want to raise short-term rates 3 or 4 times in the coming 12 months, speed up the process of tapering at asset purchases, and maybe start later in the year to start to sell assets, so to bring the Fed's balance sheet back closer to where it was before. So I think that's the appropriate mix of policy, and I think that's what Powell and the other Fed leaders are likely to do. Okay, other questions? Let's see.
I didn't see any others.
Oh, just nice comments. Excellent presentation.
Yes.
Okay, I'll take it.
So with that, I want to thank you for sharing your thoughts on what the year ahead holds and some of the things that our investors should be keeping in mind. And also thank you to the audience for such excellent questions.